We've been talking so much about renters' rights, so let's have a chat about something else. What can landlords claim against tax? So, why don't you subscribe, first of all, to Maxine Lester TV, where we give you daily updates on all things rental. Today, we're talking about something every landlord needs to understand: what you can claim against tax as a residential landlord. Now, first things first, I am not your accountant, and tax advice should always be checked with a qualified tax advisor because all things are really personal. But as a letting specialist, we see every day where landlords miss out on legitimate costs, lose paperwork, or misunderstand what is and actually is not normally claimable. And with making tax digital, changing how rental income and expenses are reported, good record keeping is no longer nice to have, might do it in a bit. It's becoming essential. So, what can you usually claim? The basic rule is this: the cost normally needs to be wholly and exclusively for the purpose of renting out the property. In plain English, that means it must relate to running or maintaining or managing your rental business. So let's start with the obvious one: repairs and maintenance. If you repair a broken boiler, replace damaged roof tiles, fix a leak, repair faulty electrics, decorate in between tenants, or maintain the property so it remains in good condition, those costs are usually allowable. But there is an important distinction: repair is different from improvement. So if you replace a like-for-like kitchen because the old one is worn out, it may be treated very differently from installing a luxury kitchen that significantly improves the property. Repairs are generally claimed against rental income, while capital improvements may be dealt with differently. Often it comes around when the property is sold. HMRC makes this distinction clear in its property guidance, so something for you to have a look at. Next, you can usually claim letting agent and property management fees. That includes the cost of having your property professionally managed, the tenancy administration, rent collection, inspections, compliance checks, and other services connected to running of the rental. And this is where good management does two things: it helps protect your income, and it helps to keep your records organised. You can usually claim professional fees such as accountancy fees for preparing your rental accounts and some legal fees linked to letting the property. But not every legal cost is treated the same, so always check before assuming anything. Then we have insurance: buildings insurance, contents insurance for the items you provide, and rent guarantee insurance may usually be included as rental business costs. HMRC's property notes include insurance, rent, rates, ground rent, similar property costs as claimable categories, provided they relate to the rental business. Now, let's talk about mortgage costs, because this is one of the areas that landlords often misunderstand. For individual residential landlords, mortgage interest is no longer simply deducted from rental income in the way that it once was. Instead, residential finance cost relief is restricted to the basic rate of income tax. HMRC confirms that tax relief for residential landlords' finance costs is restricted to the basic rate. That means if you're a higher rate taxpayer, this can make a huge difference to your tax position. And this is one of the reasons it's so important to speak to your accountant before buying, before refinancing, or moving a property into a different ownership structure. You may also be able to claim service charges, ground rent, council tax, utility and water rates, but only where you, as the owner, are responsible for paying them as part of the rental business. For example, if the property is empty between tenants, and you pay the council tax or the utilities during those periods, those costs may be relevant. Again, keep the invoices and make sure the costs are clearly linked to the rental. Now, what about furniture, appliances, and carpets? We're asked this a lot. This falls under something called replacement of domestic items relief. They've got a name for everything. Broadly, this can apply when you replace certain domestic items in a residential rental property. For example, replacing a worn out sofa bed, a fridge, a washing machine, curtains, or carpets. But the key word is replacement. It doesn't usually apply to the first time you furnish the property. HMRC guidance says relief for this, or for replacing domestic items, is not the original purchase. So if you're upgrading or replacing items, don't just throw away the receipt, keep it. Record what was replaced and make sure your accountant knows exactly what the cost relates to. You can also claim advertising and marketing costs connected to finding a tenant. So that could include property advertising, photography, listing costs, and other reasonable market expenses connected to letting the property. Then we've got the safety and the compliance costs, gas certificates, electrical inspections, EPCs, Legionella risk assessments, smoke alarm checks, carbon monoxide alarm checks, and other compliance-related costs are part of running a safe, legal rental property. And this matters because these are not just tax records, they are also protection records. So if there's ever dispute, an enforcement inquiry, or possession issue, being able to prove what was done, when it was done, and who did it can be incredibly important. And don't forget, you've got to have agreement that your tenant has actually seen it. You may also be able to claim travel costs, but only when the travel is genuinely connected to the rental business. For example, visiting the property for an inspection, meeting a contractor, or dealing with a maintenance issue may be relevant. But personal travel cannot simply be dressed up as property costs. Office costs can also sometimes be claimed, such as stationery, postage, phone use, software, and a proportion of home office costs, where appropriate. But again, the private use element needs to be separated out. Now, what can you not usually claim? You can't usually claim the capital repayment part of your mortgage. You can't reclaim your own time as if you were paying yourself wages. You can't claim private expenses. And you cannot simply claim improvements as normal running costs. And this is where landlords can accidentally get into trouble. They think, I've spent money on the property, therefore it must be claimable. But tax doesn't work quite that simply. There's also the £1,000 property allowance. HMRC says the first £1,000 of property rental income can be tax-free, but if you use the property allowance, you cannot deduct your actual allowable expenses for the same income. So for some landlords with maybe one property, the allowance may be useful, but for most landlords with 2 or 3, 4 properties, with proper rental costs, repairs, insurance, agents' fees, compliance expenses, claiming actual expenses may be more appropriate. Again, your accountant can tell you which is best. The big message is this: don't wait until January and then try to remember what happened months ago. Keep your invoices, keep receipts, keep statements, keep certificates, keep notes of what each cost related to. Because the best landlords don't think about rent coming in, they think like a business. At Maxine Lester, we really help landlords keep their property rental organised, compliant and professionally managed. We can't replace your accountant and never would say that, but we can help make sure that the property side is properly recorded, properly managed and far less stressful for you. So please speak to your accountant first, check what you can claim and make sure that your rental property is being run like the business it really is. Why don't you subscribe to Maxine Lester TV for daily updates on all things rental? And if you want to make your property easier to manage, just message us at the team today. We look forward to talking with you.